$1,000 a month, $3,000, $10,000, 3 dividend incomes, 3 different lives. John's about to find out what each one really costs per day. In this video, I'll show you exactly how much you need to invest today to hit those dividend levels. You'll see how time does the heavy lifting over the long run. I'll walk you through the ETF selection criteria behind the portfolio, and by the end, I'll show you how single-digit daily contributions reach $1,000 and $3,000 a month in dividend income, plus how just $18 a day builds a $1.8 million portfolio paying over $10,000 a month. Now, before John can build any of that, he needs to understand why he can't just buy the market and expect it to pay him. The S&P 500 used to pay you to own it. For nearly a century, from the 1870s through 1960, the dividend yield on the index never dropped below 3%. By the 1980s, it was averaging around 4%. 20 years ago, it had drifted below 2%. Today, it's 1.1%, close to the lowest yield in the entire history of the modern stock market. The index every American is told to buy as their default investment has gone from being a real income product to barely paying anything at all. If you put $100,000 into the S&P 500 today, the dividends pay you about $90 a month. That's not income. That's a rounding error. Now run that math the other direction. Want $1,000 a month in dividends out of today's S&P? You'd need a $1.09 million lump sum sitting there. $3,000 a month is a $3.27 million pile. $10,000 a month, almost $11 million. $11 million. Nobody has that sitting around. Almost nobody has any of these numbers. And this is not just an S&P problem. Find a fund yielding 5%, twice what most dividend ETFs pay, and you'd still need $2.4 million up front to pull $10,000 a month. The capital is the real bottleneck. So how do you get there with a single or double-digit investment a day without the lump sum? The answer is time, and the math behind it is smaller than you think. Here's how that works. Say you put $1,000 into a stock that costs $5 a share and pays a 5% dividend. That gets you 200 shares. Those 200 shares pay $50 a year. End of year 1, the dividend paid is $50. Instead of cashing it in, you reinvest it. And assuming the share price stays at $5, that buys you 10 more shares. You're now at 210. Year 2, those 210 shares pay $52.50. Same move, reinvest it. That gets you 10.5 more shares. You're now at 220. Year 3, the dividend climbs to $55. Reinvest it. 11 more shares. You're now at 231. 3 years in, your dividend is bigger than it was in year 1, your share count is higher, and you haven't added a single dollar since the original deposit. And the snowball has more than one way to grow. You see, the share price never moved in this example. The dividend never grew. Good dividend ETFs actually do both. Speaking of good ETFs, what actually makes one good? For John, 3 things: what it costs to own, what it screens for, and how long it's been doing it. He runs every dividend ETF through those 3 screens. The ones that pass make the portfolio. The ones that don't, John skips. First is the expense ratio. This is what the fund charges you every year just to own it. It sounds tiny. Most dividend ETFs charge somewhere between 0.06 and 0.5%. Over 30 years, the difference compounds and eats a meaningful chunk of the dividend income you're trying to grow. John's rule is simple: as low as the strategy allows. For broad U.S. dividend ETFs, that means well under 0.1%. For international funds and specialty screens, slightly higher fees are the cost of access. Anything above that line, John skips. Second is what the fund actually screens for. Every dividend ETF follows some kind of methodology. Some screen purely for high yield, some screen for dividend growth, some screen for years of consecutive dividend increases. The high yield only funds tend to look great on day one, but underperform for the next 30 years, because high yield often means a stock with problems. John wants funds that screen for dividend quality, the combination of yield, growth, and consistency, not just yield alone. Third is track record. A dividend strategy only proves itself over decades. A fund that's been around for 3 years can tell you what its yield is today, but it can't tell you whether the dividend will keep growing through a recession, a rate hike cycle, or a tech crash. John wants at least 10 years of dividend history, with one acknowledged exception that we'll talk about later on. 5 ETFs pass all 3 of these filters. They tell a very specific story together. Next, I'll show you the 5 funds in John's portfolio, then how single-digit daily contributions reach $1,000 and $3,000 a month in dividend income using that portfolio. Plus, how just $18 a day builds a $1.8 million portfolio, paying over $10,000 a month. But first, here's the ETF lineup for the portfolio. John starts with the foundation everyone else builds around, SCHD, Schwab U.S. Dividend Equity ETF. It holds 105 of the strongest dividend-paying companies in the U.S., names like Merck, Coca-Cola, Texas Instruments, Chevron. It pays a 3.39% yield today. The dividend has grown at 10.43% per year for a decade, and the share price has added 8.71% annually on top of that. The expense ratio is 0.06%, about as cheap as a dividend ETF gets. For most dividend portfolios, SCHD is the foundation around which everything else gets built. Next is SDY, SPDR S&P Dividend ETF. SDY screens for one specific thing. Every company in the fund must have raised its dividend every single year for at least 20 consecutive years. So every name in this fund has paid through the 2008 crash and COVID and kept raising the dividend through both of them. Run the numbers, and SDY pays a 2.49% yield, grows the dividend at 6.23% per year, and adds 6.18% in annual share price appreciation. The expense ratio is 0.35%, higher than SCHD, but that's the cost of the 20-year Aristocrat screen. Next up is DGRO, the iShares Core Dividend Growth ETF. It holds companies actively raising their payouts, but with broader exposure than SCHD's tighter 100 stock screen. It comes in at a 2.03% yield, an 8.91% dividend growth rate, and 10.39% annual share price appreciation, the highest appreciation rate of any fund in this portfolio. The expense ratio is 0.08%, nearly tied with SCHD for the cheapest in the lineup. Fourth on the list is FNDF, Schwab Fundamental International Equity ETF. This is John's international value play. Most international ETFs weight stocks by market cap, which means you end up overweight in the biggest companies regardless of whether they're good investments. FNDF weights by fundamentals, sales, cash flow, and dividends. The yield comes in at 3.05%, with dividend growth of 12.12% over the last 10 years and 7.46% annual share price appreciation. The expense ratio is 0.25%, the cost of getting fundamental weighting in international markets. And here's the exception that I mentioned earlier, INTF, the iShares International Equity Factor ETF. It's only existed since 2015. Apply the 10-year filter strictly and INTF gets cut. But over its decade of existence, the dividend has grown at 18.21% per year. That's an unusually high number, well above what most international funds have done historically. The yield is 2.66%, share price appreciation has averaged 5.47% annually, and the expense ratio is 0.16%. Now, look at all five together. Blend them at equal weights, and the portfolio comes out at a 2.72% yield, an 11.18% dividend growth rate, and 7.64% annual share price appreciation. That combination is what does the work over the long run. One quick note, every projection in this video assumes John is investing inside a Roth IRA. That means the dividends grow tax-free. Now, 3 different daily contributions, 3 different monthly income outcomes. John starts with the smallest tier first, the floor, $1,000 a month. To reach that with the portfolio John just built, he commits $2 a day, about a gallon of milk or a coffee. Here's how that plays out. Year 1 ends and there's $730 in the account. 10 years in, the portfolio is projected to reach $12,219. The monthly dividend would pay $32. The reinvestment loop is now starting to compound. By year 20, the portfolio is projected at $51,614. The monthly dividend would climb to $198, meaning each year the portfolio would pay out more than 3 times what John is putting in. Year 30 is where the snowball lands. The portfolio is projected to reach $206,694. The annual dividend would hit $13,359 or $1,113 a month, every month for the rest of John's life. Of that $206,694, John would put in $21,900 over 30 years. The market would add $184,794. Of that market portion, roughly $102,181 would come from capital appreciation, and $82,613 would come from dividends being reinvested back into the portfolio, buying more shares, generating more dividends, all on a loop. The next target is $3,000 a month. Same 5 funds, same 30 years. John just triples the daily contribution to $6, the cost of a fast food lunch, $2,190 a year. Here's the math. 10 years in, the portfolio is projected to reach $36,656. The monthly dividend would pay $96. By year 20, the portfolio is projected at $154,841. The monthly dividend would climb to $594. The reinvestment loop would now be doing more work than the contributions are. 30 years in, the portfolio is projected to reach $620,083. The annual dividend would hit $40,078 or $3,340 a month, every month for life. John would have put in $65,700 over 30 years. The market would add $554,383, and of that market portion, roughly $306,543 comes from capital appreciation and $247,840 from reinvested dividends. Okay, so now the question is, what does $10,000 a month actually require? Most people assume $10,000 a month in dividend income can only be achieved by people who already have money to start with. Not true. For this target, John commits just $18 a day. 2 coffees and a bagel. About $540 a month going into the portfolio. That's the entire cost of the highest tier in this video. Here's what the projections show. By year 10, the portfolio is projected to reach $109,967, paying $288 a month in dividends. To most people, that looks like the answer is already broken. 10 years in, the income is roughly $3,500 a year, nowhere close to the goal. Why keep going? Well, stick with it. Year 20 is where the math finally starts working overtime. The portfolio is projected at $464,524, paying $1,782 a month. The contribution hasn't changed. It's still just $18 a day, but the account is now paying John more in monthly dividends than he's putting in across an entire month. That's the part most people never get to see because most people quit somewhere between year 5 and year 15 when the math still looks too small to bother with. Then year 30 hits, and the portfolio is projected to reach $1,860,249. The annual dividend is $120,234, which works out to $10,020 a month every month for the rest of John's life. John would have put in $197,100 over 30 years. The market added the other $1,663,149. Roughly $919,629 of that was capital appreciation, and $743,520 was dividends being reinvested back into the portfolio for 3 decades. Now, take a look. Here's all 3 side by side. The daily amounts are achievable for almost anyone who can save anything at all. The portfolio values are real wealth. The monthly outcomes are life-changing. Same 5 funds, same Roth IRA. $2, $6, or $18 a day. Pick your tier. The factor that makes any of these possible is time. 30 years of $2 a day builds a $206,694 portfolio, which pays $1,113 a month. $6 a day would build $620,083, which pays $3,340 a month. And $18 a day would build $1.86 million, paying $10,020 a month. But what if you don't have 30 years? What if you want to retire on Fidelity Index funds in 20 or 10, starting with 0? I ran the math on all 3 timelines, and the monthly cost to retire in 10 years isn't what most people guess. And that video is on screen right now.